This is where it gets fun tonight. Every year we do these fireside chats, and the reason I dressed up was because we let anything go here. I actually tell people to turn off the cameras, nobody's recording. We let it all go, and I think every year from the survey, this is the most highly ranked panel that we have. And we've got a great group of panelists, so I'm gonna bring them out. So Jeffrey Rosenberg, Peter, Ollie, can you guys come out? Have a seat real quick. So I'm going to do quick intros here, but Jeff Rosenberg is from BlackRock, Managing Director of Systematic Fixed Income. He's got so many degrees. I don't even know, 3 or 4 degrees. I can't even count, Jeffrey. He's really much smarter than me. Ollie is the founder and lead portfolio manager at Invenomic, and he's got some incredible opinions you're going to hear about tonight. And then Peter, he's a managing director at iCapital, who's a $250 billion alternatives platform. But before we get started, I really can't go 88 miles an hour and go into the future without Marty McFly. So does anybody know, where's Marty McFly? Where's Marty McFly? Yeah. This is Dr. David Stubbs. You wouldn't know it with a skateboard, but David was a perennial favorite at our conference every year. He came to the last 2 conferences, been a part of the fireside chat. He most recently came to us from Blackstone. So I like to say we stole him away from Blackstone. Prior to that, he was at JP Morgan, chief strategist there. Now he's our chief investment strategist at AlphaCore. So we're gonna have Q&A with everybody, but I'm gonna open it up to some easy softballs for these guys, and then ask as dramatic, as controversial question as you want, okay? So I'm gonna talk a little bit about, we'll get it going. So maybe we'll start with Ali. What do you think about the government shutdown and what impacts it might have?
I don't really think it's as relevant. I think they'll figure this out between them. In the end of the day, I think this is something that seems to be both sides coming together a little bit. And so I think it'll pass without being a big issue, personally.
Okay, Jeff, any thoughts?
It could. This one is different. It feels different. Most of the time we ignore them. We're not ignoring this one because Trump's threatening a significant fiscal contraction. That's the difference. So if you permanently lay off, as he's threatening to, it has a broader macroeconomic impact. Obviously there's an off-ramp. The off-ramp is the healthcare subsidies. He seems to be open to it. Markets aren't too concerned, but the tail risk is a bigger fiscal contraction.
Is there a time window you think that we can handle in another couple of weeks, or we can't handle 3? Is there a number?
Yeah, about 30 days is about the longest that they've gone before stuff starts to break. I was worried that my flight was going to be, sicked out, and the FAA could shut this shutdown down immediately if they decided to. Right. Not the FAA workers, the ones who control our air traffic. But you're going to get to the Obamacare subsidies dropping off and people seeing the increases in the ACA. That's the Democratic ploy. Maybe the Republicans are going to try to head that off before it shows up. So I think that's the time window.
Great. Anything you want to add to that?
Yeah, I think pretty similar view where we think the economic impact's pretty small. I think if you look historically, it's about 15 basis points off of GDP per week, with it recouped pretty quickly thereafter.
Right.
If we do get layoffs, maybe that does increase a little bit more. I looked at call sheet this morning, and I think it was, the longest shutdown was 35 days. Right now, it's about 26 days is how long they're predicting it to be shut down. So I think the things that we're really focused on are key dates. The 15th, the military, or 1.3 active military members will get paid. That's going to be a key date to where constituents might start to get a little bit more frustrated with the shutdown.
Right.
And then also October 18th is going to be a date that we're very focused on. That's the end of the reference period for the October non-farm payroll report. So the last report was already delayed, and now there's a chance that the next report could get delayed. And given the cooling in labor markets that we've seen, that just adds further uncertainty to markets right now.
I know Peter's looking at me saying, hard to take me seriously right now. I just want you to know.
I think I'm a little overdressed right now for this panel.
So David, do you have anything to add?
Yeah, I think the shorter term kind of issues when you certainly start to escalate and spiral once you get past a few weeks. I'll just say that it's part of this broad sense of dysfunction. I mean, yes, we've been dealing with these shutdowns now for 10 to 15 years. And in the last 10 to 15 years, what's happened? We've had spiraling debt. We have no consensus in Washington in how to deal with either the revenue side or the spending side, and it doesn't help that sense of fragmentation and a lack of trust that people are starting to price in around the caliber of U.S. policymaking. It's just not very helpful.
Right. I guess that brings up the next question, which I think we're going to open it up in a few minutes here. But talk about the decline of the dollar, the rise of gold, the rise of Bitcoin, the ridiculous amount of spending. I know Ali's got an opinion on this. What are your thoughts, Ali?
I mean, in the end of the day, from a macro perspective, I would say I'm not necessarily an expert, but it seems like we, have had a lot of money flooded to the United States. There's a huge amount of investment here. It's at peaks of all-time levels. Some of the other countries are getting their acts together. They're being a little bit more stimulative. You should start to see some money flow back towards them over time, I would say.
Great. Anybody else on?
I think it has to be something that's front of your mind if you are, living here, having a vast amount of exposure to US dollar. The dollar does tend to move in multi-year cycles. We've gone through a long one, almost 10 years, depending on most measures. You now have everyone, because of the big move in the dollar and the markets, that everyone externally outside the US realizes they have a vast amount of exposure here. And I think what we've seen, that it seems to be consensus, we've seen a very weak 6 months in the dollar because not because people sold a lot of stuff in America, but because they hedged their currency exposure, right? They realized how over their skis that they are. And that's why I think that we believe in international investing in AlphaCore, right? There's lots of opportunity outside of the United States, and we see, I think, far too many portfolios that are 100% US, and you can smartly diversify away and at least control that risk, the risk that we are at the beginning of a multi-year decline in the dollar. It doesn't mean it's going to be a dramatic collapse, right? It could just be a few percent each year, but you add that up, it could be material.
I'd say maybe just a little bit on the flip side there. I think your points are well taken, but when I hear the decline of the dollar, the one thing I kind of think of is this the end of U.S. exceptionalism? Feels like a question that we've gotten quite a bit this year. And I think when you think about what are the alternatives to the dollar, where are these large central banks or sovereign wealth funds going to invest their holdings, there really aren't many markets that are deeper and more liquid than what we've seen in the U.S. Treasury market. So it does feel like, for the time being, that there is still this staying power for us being the reserve currency, or a place that people feel very comfortable investing their money. And then the other thing I'd say is, there's a lot of ways that you can kind of think, okay, how our currency is going to be trading in this environment. But one other thing I think is important, think about growth differentials, and or just look at where growth has been in the United States. It's held up pretty resilient so far this year, despite all the headwinds. And you compare that to some international economies right now, maybe that doesn't stop the decline in the dollar, but maybe it does give out to like this quote unquote timeout, to where some of the move that we've seen over this year does start to pause a little bit.
Just a couple of kind of facts to keep in mind on this story is there's also basic fundamentals. Real interest rates have been falling. Real interest rates are falling because inflation, nobody's talking about it anymore, but it's sticky and it's well above 2%. It's actually going up. There's an expectation as Trump tariffs roll through, it'll go up further. That further decreases real interest rates, and the Fed is not looking at that. It's looking at the labor markets, it's looking at the revisions. So they've signaled and they pushed into the markets a big decline in expected rates. And so when you have falling real rates, that bolsters both gold and alternatives to the dollar. And so that's part of what's going on. I think you have a fundamental trigger, and then you can get a little over-enthusiasm in the market. I think you see that in kind of the speculative frenzy. Maybe we'll talk a little bit about that in many aspects of our markets, but you're also going to see that, for example, in gold. It's not an alternative to the dollar. Over the long run, it can be an alternative to inflation and inflation hedges, but in the short run, you face the valuation risks.
Do you see more upside in something like gold? Do you think it's rallied too fast, too far? Anybody have any comments? Go ahead.
I mean, I don't have any comment other than it will have upside over time. It's just a matter of how much time, and I think that the pullbacks can be pretty severe, and if you're looking at it as your security blanket, that's something you need to consider, I mean, personally, if I look at it, I would rather own, cheap unlevered real estate than gold, because it still provides some element of that hedge. And I think that you could buy it cheaper than you can buy gold, for example, right now. So, I think it'll go up over time. It's a nice hedge, but it's not going to go up much from here on a relative basis. So I think it's got a lot of the gains in there.
Interesting. Well, so we've had over the course of, I think many of us have been investing for 30 years plus, maybe more. There's seems to be almost every 5 years or so, there's a major shock. We dealt with the interest rate shock in 2022. We had the COVID shock. We had the '08 shock. Do you guys see anything on the horizon? Obviously, earlier this year, we had a tariff shock. What do you guys think might be the next shock?
I mean, I think, we need to keep in mind that markets are trading at the highest levels they've ever traded at on every single metric, except the PE and the CAPE ratio, which are 10% off all-time highs, and with the most aggressive accounting we've ever seen. And the free cash flow yield for the market has absolutely evaporated. And this has all been driven by an AI rally that is at this point, I saw a chart in one of the earlier presentations, and the axes were a little bit weird, but it showed, AI or the current CapEx cycle, and then it showed the tech spend, and then it showed the housing period, and it was going until the middle of this year. We were already at 6%, but if you think about that, 6.2 was the tech peak, 6.8 was the housing peak. If you think of the durability of a house, and if you're going to go and overspend, those houses are still with you. If you're going to go lay fiber optic cables around the world, still we're lighting up some of those cables. And then the other thing you have to think about is if that's at 6 and that's in the past, well then if you grow the 30% of expectations, that takes us to 7.8. So this whole thing is being driven by something where everyone seems so comfortable with the idea that we're going to be in a bubble bigger than any other bubble and should value that at a higher level than at any other time in history. And I think that that's a really, really risky proposition at this point.
Any comments on that?
Abso-effing-lutely.
Now it's getting interesting.
I mean, so there's a lot of interesting stuff going on in the world, but there is a frenzy. This is the summer where AI turned ugly. And what do I mean by that? The initial phases of the AI CapEx investment. First of all, we don't have earnings season anymore. Anybody notice this? We have CapEx season. Everybody talks about in the headlines are the CapEx spend. Some of us are still looking for the earnings. And when you ask, what are the revenues going to be? It's a lot of hope. And I do vibe computing. I can code and write software in a manner that I've never been able to do. This stuff is amazing, no doubt. But no one really knows how much it's going to ultimately deliver in terms of revenues. And we are building, what are the estimates? $450 billion in capital expenditures today. What Ollie was just talking about. We're not building houses or fiber that have 30-year depreciation schedules. These are chips. They have maybe 3-year life cycles, maybe 5-year. The estimated depreciation losses of the current CapEx are 4 times anyone's best revenue guesses. So the math doesn't add up, but the good news is Americans and the world, well, maybe the Chinese still know how to do it. We don't know how to do math. And so that's working for the markets, but at some point it's going to come back to gravity. And so you want to kind of pay attention to where your portfolio is allocated and the frothiness that's in some of these valuations.
Yeah, I mean, the one thing I would add is, we are a small firm. We've had an agent named Vincent working with us that we built 3 years ago. So I think what's happened is that if you look, the Fed does a survey every 2 weeks of utilization of AI among firms by cohort size and how much you plan on using it. The big firms have flatlined. All the firms except 1 to 4 employees. So what we really had is this huge movement of a lot of kids doing homework on ChatGPT, a lot of small firms coming out and saying, wow, this is super valuable, and obviously it's still a CEO or someone who runs their company, and so they're going to go out and talk, and it is valuable. But if you're starting to see a saturation off of the past capital is used, then at this point, what are we going to do when we go into next year? So I think this is really concerning.
Yeah, I wouldn't have too much to add versus what's already been said about AI, but while we do believe in the long-term opportunity set that AI does offer, I think the question's really becoming what's real demand versus what's just dollars changing hands.
Right.
So I think you referred to it as CapEx season, but it'll be very interesting to hear kind of what the return on invested capital is going to be for a lot of this stuff.
Yeah, and all the risks they're talking about, you get if you just buy a tracker fund, right? You don't have to buy an AI-focused, like high, momentum, whatever it is, right? If you just own the U.S. stock market or the NASDAQ, you have that, and trying to control some of that is what we do. You mentioned when we were up here and dressed normally.
Right. It's really uncomfortable, by the way.
About all the concentrated equity that comes in, and a lot of that is direct AI plays. I would refer you back to the data center panel. There's lots of different ways to invest in data centers, but if you get it right, and I would say my old employer, Blackstone's a leader in this, is, if you're investing in data centers there, they are signing 10-year contracts at high yields with extremely strong, reputable companies like the Metas and the Microsofts. And that means that it's actually on Meta and Microsoft if the investment is actually, it doesn't pan out. You'd have to be in a very strange place where Microsoft's going to default on a contract. And the depreciation is very well taken, but certainly the Blackstone ones, the chips inside the data centers are bought by the tenant. They're not owned by the real estate, right? So in that way, it's a very de-risked place, right? It's Microsoft and Meta that are desperate for this capacity. They're overpaying, and yes, it could all end in tears. And if you walk in and to our office and all you've got is this AI stuff, I'd say, well, maybe sell a bit of that, but buy some data centers. There are other ways to play it, not risk-free, but like a lot less risky than what we're seeing right now.
I'll touch on one little thing about, do you think we're entering a world of deglobalization with tariffs and China and obviously all the political ramifications that we've got going on? Anybody want to talk about that and how you might position a portfolio?
Yeah, I think deglobalization is definitely something that comes up a lot. I think that there are two things I would say. It feels like it's almost maybe more of a multipolar world where people are trying to figure out where their alliances are. Like just kind of, are you going to align with the US or China is basically what it comes down to. I also think the one other aspect for why deglobalization might be kind of an overplayed word is because if you look at, right, we know that imports from China have come way down, but if you look at countries like Mexico, Vietnam, Singapore, et cetera, all those imports are increasing. So it's not necessarily deglobalized world, it's just coming from other countries back into the US. So I think it's maybe a little bit overplayed, that word.
Yeah, I would say moving from like pure globalization, as it were, to kind of a regionalization side of things. The benefits from globalization, were very clear in a very simple model of the world, right? We outsource stuff, we get like much cheaper things, et cetera. It's a poverty reduction mechanism in China, and that's all true. But the theory didn't encompass resilience to something like COVID, resilience to something like a massive economy on the other side of the world that is acting in a predatory manner. To both our public and private sector bodies, and the desire to unpick that and create resilience in your supply chain, resilience in your geopolitics, the ability to defend your intellectual property, the ability to defend your borders. That is now front and center, and it's having a big impact already. I think we're probably past the high watermark of pure globalization, even though trade flows, I think, absolutely, to your point, are going to be resilient. Yeah.
I'll talk about inflation first, and then we'll go to questions from the audience because we've got a great band playing called Betamax later. So we'll go to inflation. Do you think we've tamed inflation? Do you think it's continued down, or is it going to turn back up? Does anybody have any comments on inflation?
I said it earlier. I think we're sticky in terms of inflation. I don't think we're getting back down to 2%, but tamed inflation off of the COVID spike. We're not going back to those levels, but we may not get back to the 2% level that we had pre-COVID.
Yeah, I mean, inflation expectations are high twos at this point, 5-year forward. The one other thing, just kind of relating back to valuation, this is the first time really in almost history that if you take the earnings yield minus inflation expectations, it's negative, right? So like we've never gotten to the point where the earnings are not covering the inflation. You need the value of the actual assets to cover and the growth in those to cover it from here on out. Right. So, you know, inflation being a little higher definitely seems that way.
Yeah, I agree with the comments. I think the one thing is coming into the year, we're all focused on how tariffs were going to impact inflation. And if you look at the pass-through of tariffs into core goods or core goods actually used in new cars, it feels like it's been pretty non-existent. I think what has been a little bit more concerning is over the last few months, it does seem like the service side of the equation has firmed up a little bit. If you look at shelter prices, we've had back-to-back month readings of over 0.3%. That's versus a trend rate that was closer to 20 basis points from February to June. So I think the one thing where we were having a little bit more comfort on the inflation narrative was the fact that even if core goods did increase, core services may help offset some of that. And the fact that services are maybe firming a little bit. Yes, the year-over-year rates are coming down, but it looks like those year-over-year rates are now starting to decline at a slower rate. So I think back to Jeff's point, it does feel like it's a little bit stickier, probably going to run above the Fed's target, but the Fed also in their SEP has core PCE at 3.1%, so it feels like they have some of those risks in their forecast at this point.
Anything you'd add, David?
Well, just the big picture is obviously 2010s had very low inflation because we had a lot of weakness. Weakness in the labor market, mass unemployment, weakness in the housing market, far too many houses, weakness in the banking sector. It was close to being insolvent, certainly was in Europe. And all that has healed. Right? The private sector has never been stronger in this country. Right? Mm-hmm. You have a clear shortage of house building relative to the population. We're building about the same number of homes we did in the 1960s, and the population has more than doubled since then. And now, of course, we're moving into a shortage of workers. Demographics was going to do that anyway, and now here comes the Trump administration with the most dramatic U-turn in immigration policy. So I think in the short term we have like rents cooling a little bit because there are a lot of multifamily homes were built just in a short 2-year period, and we have some other things going for us. But I think we have to settle in for a period where inflation is going to be probably closer to 3 than 2, and even that requires some restraint from policy. So yes, we're in a very different era. We've moved from the vicious cycle of the 2010s of disinflation and weakness to arguably a virtuous cycle of economic strength, good balance sheets, strong investment, higher productivity. But with this comes periodic bouts of inflation when you're dealing with a constrained supply of houses and people.
Right. Just one other point on that, because David makes a really good point. I make it in many of these kinds of settings. If you forget everything that I say as a bond guy, remember this. Pre-COVID, there was too little inflation. Post-COVID, there's too much inflation. And the implication of that is on your bond portfolio and how the Fed can respond. When there was too little inflation, Fed could cut interest rates as much as it needed to. It was called divine coincidence. And it meant that we had a very powerfully diversifying bond market. An era of too much inflation, it's what the Fed's grappling with right now. What Powell just said, there is no risk-free path. If I do too much, then I risk too high of inflation, and if I do too little, then I risk the labor markets, and that tension holds the bond market diversification property down relative to what you had in the pre-COVID environment. It's a major structural change.
And you're totally preaching to the choir. This is obviously the core of why we use about AlphaCore, what we do today, why we look at diversifying funds, like we have 2 managers here on the left-hand side. And it boiled down to an extreme version was 2022, right, where the bond market caused the problem, right? Inflation went up, Fed had to hike interest rates, bond yields went up, that hurt your fixed income, destroyed equities, everything lost money with the exception of cash, alternatives. I think I would like to think we were on agreement that we're probably not going to see something as severe as that again because we were coming out of COVID. It was a unique environment. But could we see periodic elements of inflation rising to 3.5, 4? We might be at the beginning of one of those right now if the tariffs come through. And at some point that disturbs the bond market, disturbs the equity market. Everything's correlated. There's no diversification unless you're using these tools,
That's right.
both the private stuff and the uncorrelated public stuff. That's the very heart of why we're all here.
I want to open up to the audience because I know we have questions. So wait for the mic to come because we've got We got Jennifer, we got Lisa. There you go.
Thank you. Earlier on, Dick asked about, is there anything that we might be missing that could be a problem, like the problems in the past that seem to be surprises. Does anybody have any concerns about consumer or household debt today, the levels of debt today?
I mean, we're seeing issues developing massively. We saw, we're seeing right now houses have mortgage rates that are past 2013 levels. They can't really refinance into lower levels. We're seeing defaults start to pick up, slowly as student loans are having to be paid off again. I think the consumer would benefit a lot from rate cuts, but as David said, it's really, really hard to give big rate cuts. And there's a big gap between where the consumer is solvent or in good shape and where they are right now. And so I think that's a big problem. When you look at 1%, so top 10% has 54 trillion in financial assets. The bottom 90 has zero. So this is a problem because, as rates are high, what people don't realize, it's stimulating us all. The rich people are super happy. If you have a $10 million account, you're getting a $450,000 a year in income while someone on the other side is choking. But as we go into midterms, there's this awkward balance where they have to cut rates, but they can't really in order to save that person. So it's going to develop a little bit into a credit issue. So, it feels like that would probably be something that starts to develop here as we move forward through the next year.
Yeah, in aggregate, the consumer balance sheet, the assets versus liabilities, looks incredibly strong. Under the surface, that's a distributional issue. And if there's credit that is focused on the low-income consumer, we've just seen it with the auto loans in Texas, et cetera, you've probably been reading about that, then there's going to be periodic issues in credit, for sure. And we're working with our managers to understand those.
Yeah, I think it was funny, after COVID, during COVID, there was talk of a K-shaped economy. And it feels like that has come back into the vogue a little bit over the last few weeks, where just looking at some of the delinquency data that we've gotten from the low-income consumer, that does seem to be coming into the forefront a little bit more. But I'd say the one thing on, credit card balances continue to come up a lot in headlines, or just consumer delinquencies come up a lot of headlines. But if you look at credit card balances as a percentage of disposable income, so even though credit card balances have been going up, so is disposable income. So if you look at that ratio, you're actually not back yet to pre-COVID levels, or even back to levels that we saw back in the GFC. That's not to say that there can't be issues in the consumer. Like we said, we've seen that from a low income standpoint, but from an aggregate standpoint, it looks like at least the income side of the equation should help offset some of the increases that we've seen in debt.
So a couple of you mentioned that the price value metrics are just sky high. So the question is, should we be shifting our allocation substantially away from equities and potentially into debt? And if so, should it be short-term or investment grade, or should it be short-term junk grade, or what should we be doing?
Do what your advisor tells you based on your financials. I'm serious, right? You may be in a different, everyone has a different position in life. Everyone has a different age and goal. And so I think that's why it's so important in the end of the day to have a good advisor that could guide you to where to go. If you go buy a bunch of bonds and inflation picks up, you're going to regret it, so you don't want to go all in on that. But at the same time, you want to keep that balance. And I think that's why you want an advisor in the end of the day that's good. And so...
Yeah, we know a few of those.
It's the facts.
We know a few advisors. Yeah. We had some questions.
Thank you for your comments about inflation. I do have a question about deflation. Is there anyone on the panel that's worried about deflation, and whether you are or you aren't? How do we differ from Japan, which infamously had a deflationary period despite fiscal spending?
Well, the kickoff to their deflationary was a massive deflationary shock to their assets. And that created a balance sheet recession, and that created the deflation. So, you could have that trigger. The big difference is we have, perhaps we're challenging whether we'll still have it, a dynamic, open economy. What Japan always had that we didn't have is they had a relatively closed economy. We're very anti-immigration. inherit the best of the world, or at least we used to. And so that keeps our potential growth above or a high enough level so that we stay out of deflation. Deflation is basically when your actual growth falls below your potential growth because of some kind of shock. So as long as we can kind of keep that growth above that and avoid a shock, we can stay out of a persistent deflationary environment. Keep the flexibility, keep the labor market flexibility, keep the economic flexibility. That's what helps you stay out of deflation, long periods of deflation.
There you
Good question up here. This is a yield curve question. With all your risks and debt and the skyrocketing amount of debt, where do you all see the yield curve going in the next few years? Steepening, staying flat, or getting flat?
So most of the consensus is a steeper curve for the reasons that you outlined. The Fed can cut short-term interest rates, but long-term interest rates are about issuance and the difference between demand and supply. Supply is going up, demand's going down. The deglobalization, there's fewer foreigners, the movement away from the dollar, there's fewer foreigners. All of that is likely with one caveat, which is financial repression. Financial repression is a purposeful government policy to take away the free market pricing of interest rates from us in the marketplace and replace it with a mandated government-determined interest rate. Does this sound unfamiliar? Should be familiar because it was our financial system from World War II to 1950, Fed Treasury Accord of 50. David, help me.
52.
Thank you, 52 Treasury Accord. So we've done that before, and other countries have used it. So it's possible, and there's some rumblings between Mirren and Bessent that they might institute some sort of policy. So you could shift it. Left to its own, the curve should steepen.
Yeah, and this is just very, very, very topical, right? Because why would the Federal Reserve, do something that was implemented at wartime now? Right? And the obvious reason is either some kind of panic in the long end of the bond curve because people don't want to fund it, or an organization which is supposedly independent no longer becoming independent and doing what a group of elected people want for the short term. And the prospect of that occurring where the Fed starts to buy long-term bond yields to push the bond yields down, not because it helps with their mandate, but because it's what the people on Pennsylvania Avenue want, would be a huge fracturing in the institutional credibility of this country and would lead the dollar to a very significant decline, I view, because the dollar would be the escape valve in that scenario. Now, I have to say, despite all the worries, I don't think it's going to happen, but we're going to face some tough choices if the long end of the bond curve rises and it's very steep, and I would agree that's probably the expectation. And if the Fed becomes politicized and starts acting like that, kind of all bets are off, really.
Yeah, and one point I'd just add to that, there's been an analysis out there of what happens to inflation with central banks that aren't independent, and we know what a lot of those countries are. Typically, we see inflation rise about a full percentage point in the year after. So getting back to some of the comments on inflation, that would certainly bring back into concern just the credibility that the Fed has around controlling inflation. So around the politicization, that would definitely be a tail risk as well.
One of the current dilemma that we're looking at is the fact that our demand for electricity and power is quite high. We are very hopeful and overly optimistic about AI. On the other hand, we have a very low oil prices and gas prices. And the interplay between these has a lot of geopolitics and climate issues. And the position America is taking seems to be not exactly in line with the rest of the world on that interplay. How do you think this might affect our investment, especially when we talk about investing in the oil and gas in energy type project versus hedging on the fact that AI is going to make demand for power quite high? And where do we invest when we look at the climate, ESG, climate and environment?
Just a few questions there, guys.
I mean, I would just say this AI power thing, I think, is way overstated. So, like, if you look at data center power consumption as a percent of the grid, it's 4%. If you look at the bullish estimates, they say it goes to 8 to 9. What people don't realize is you can use AI on the grid, and there's nothing better to use AI on than the electrical grid to add capacity. And so there's been papers come out by Duke, by Stanford, by everybody over the past couple months that are saying we can add. So right now we're running 4 terawatts of power. You increase that by 4%, that's 160 gigawatts. You can release 120 to 200 gigawatts of power from overlaying AI on top of the electrical grid. So I think that can help manage electrical prices, but I think electricity prices have gone up so much for the typical consumer as we look at it sitting right now, going into this year, that even though oil prices didn't necessarily move up, it's still having a pinching effect on your average consumer.
So you see the oil being at a low price a continuous issue?
For oil or for electricity?
I'm talking electricity has to come out from some source. And fossil energy seems to be the main source right now. Yeah. We're not much going to get much out of the air and wind and solar. At least not in the quantities they're talking about. So do you foresee the oil prices with the geopolitics?
They get a 13 to 14%.
And the environment pressure going to stay where they are?
They get a 13 to 14% return on drilling at $60, $65 oil. So I think that they'll keep.
Where is that? You're talking about countries with deficits. Saudi Arabia has a deficit right now. Yeah. So you're talking about small oil and gas operator here, getting that kind of return. But if you look at the global, you're not.
I think he was talking about the shale patch in America, right? Yes. So domestically, the shale can still make money at that level. And look, when you have a drill baby drill president, they start drilling and the price goes down because there's more supply. It's not rocket science. Also, you mentioned Saudi. For whatever reason, the Saudis are going after market share right now. We've seen this periodically. The number one thing for oil prices, what is Saudi going to do? Right now, they're going after market share. So eventually, you're right. If Ali's wrong and AI is this huge energy, so eventually there'll be some linkage between electricity and hydrocarbons. But what dominates hydrocarbons is supply conditions, especially in the Middle East. We had
time for one more question. Yeah. There we go.
Hans, environment.
Sorry. I was just going to add, by the way, great panel, guys. Really enjoying this. The question I have is, in lay speak, if you guys would mind commenting, if the market is, shall we say, effervescent over AI, and if there's large, big valuations and it's too high, then, and if I understand correctly, that you guys sell products that are disconnected from that or that are uncorrelated, then in simple terminology, can you give some examples of how that manifests itself and how investors can, you get my point, I think.
Sure.
Ali, top 3
Yeah, so our product, in the end, we're a long-short fund. We're mostly domestic-oriented. We are very value-biased, so we're buying these huge free cash flow companies, and we're shorting the ones that people have that effervescence about, and they're the AI companies in many cases, the big ones at these huge valuations. And so, in those moments where the market struggles and those types of companies, struggle, then our portfolio really comes to life as people run to buy huge free cash flow yield, stable, traditional companies. And so, again, though, it's a balance. We always... what we tell our clients is that, your advisor's putting together a supercar and we're a component of your supercar. Now, maybe you want to tilt it up a little bit because you're more concerned about that or not, but, if inflation comes, there's other things that can affect it. So you do want to still maintain some balance, but, we are definitely probably the most likely beneficiary of that AI exuberance if it is real.
I'll just add one thing to that because it's a good question. So what Ali's fund provides is what I call crisis alpha. So when there is a crisis, he typically performs well. Now, it's not just because he only tries to perform when there's a fat tail event or some sort of crisis. His methodology of looking at stocks on the long and the short side provide him that opportunity.
We do something very similar. We don't call it crisis alpha, we call it defensive alpha, but the concept is similar where effectively, the long side of your portfolio has a more compact distribution, and the short side has a long negative tail. So when the short side hits, it overwhelms in terms of declines that you're short, that you're going up on, than what you're losing on your long side. We do it from a credit lens. We do it a little systematic input, so the style is a bit different, but the kind of idea, and this gets to your question as well, so much of what we talk about in the markets are markets going up, are markets going down. That's beta. That's exposure to the directionality. And what Ollie and I do in our funds is we try to take that directionality out. And something we haven't talked about yet, which we should talk about, what is so great about this AI shock, because we've kind of been up here kind of poo-pooing it a little bit, but I think you'd agree with me, it creates massive winners and losers. And so I came to listen to Robert Smith. Like he said, he's got 91 software companies. Not all 91 are going to make it. Some are going to win and some are going to lose. You could see he's up here telling you a story about how they're going to transition. But there's a whole other group of people out there saying not all those companies are going to survive. In the leveraged loan market, 30% of the distressed universe is software and IT services. This idea of winners and losers is already in the market, and it creates huge opportunities when you invest by trying to pick the winners, but also picking the losers, keeping balanced so that you're not going up and down in your portfolio if the markets are going up because they're AI euphoric, or they're going down because they're AI panicked.
So there are two ways I want to answer the question. I think kind of the first part gets back to concentration risk, which is what everybody's been focused on. There's actually a few interesting white papers written by a gentleman by the name of Henry Bessenbeater, talking about how actually the median stock within either US indices or global indices underperforms T-bills. You might be asking, how is that possible? I think it gets back to the point of, some of these companies do fail, but there is survivorship bias in the index itself. So even though it's the Mag 7 today, it was FANG pre-COVID, it was the banks going into 2007, it was telecom companies going to 2000. So that concentration is going to move. It will be something else in 10 years' time. So that's not this, yes, concentration risk can weigh on markets, but just don't sell out because there is this survivorship bias from an index perspective. Even though we do manage some funds, but iCapital, we are a marketplace that offers alternative investments, mainly to the high net worth channel. So what does that mean? That gives you exposure to private market assets. Some of these could either have enhanced return opportunities just due to the illiquidity premium that we've been talking about throughout today, but also in some instances also offer very low correlation compared to other asset classes in public markets, so offer that diversification benefit in the portfolio.
There's one more.
Great panel, guys. Very interesting. On a lighter note, I was wondering if any of you could share an example of when you had a certain investment thesis or idea and you had super strong conviction on it, and maybe it didn't turn out quite like you thought it would, and what you learned. Mm-hmm. And if it's amusing, even better.
I think customer concentration is a death knell, because one customer goes bad and the whole story goes bad. And I started this from small cap companies where they had more customer concentration, but I think when you see it on the level of the companies like NVIDIA, where you have 4 customers right now that are migrating away from them, or 5 customers that are 50% of your revenue, I think it starts to become really concerning. So honestly, a simple thing is just look at that and then say, how dependent am I on for this stock to work on one person's decision to move away from my business? And I think that's something that I personally stay away from.
Mm-hmm. I'll throw in a couple. I think what are the tough things about long-term thematic investing, which is what I used to head up at JP Morgan, and what is often included in a lot of private markets, is that the rationale can be there for the 5 to 10 year process, but you can go through a really tough couple of years because of other things going on. I think look at clean energy as an investment, right? It was all the rage in Trump 1.0, which is ironic, of course, because you're supposed to be anti-renewables, but that's where the world was. And they've just had a really, really tough time. Now, I don't think anyone would disagree that a few years from now there's going to be a lot more solar panels and a lot more wind, and it's part of our energy future, even if it can't be everything. Previous panel rightly said that the real secret is nuclear, but that's tough. And holding on and trying to work out what's a sell-off in a bigger trend is an exceptionally hard thing to do. So I think even if you get the long run trend right, along the way you get your heart broken many times.
Yeah, I think to quote Stan Druckenmiller, the line is often wrong, but never in doubt. So, to probably go in it with that thought process. I think the one thing is too, sometimes I think the one lesson is people get some thematic or just trying to grab onto a narrative for an investment view. And I think we see this a lot around elections, namely banks, firms like us try to put out playbooks around what asset classes, sectors are going to perform well when a certain administration comes into play. And you look at what was expected going back to 2020, energy was going to be the worst performing sector when President Biden came in. I think the last time I checked, it was actually the best performing sector under his presidency. So it's just, try not to get too involved with some of those narratives that are out in the marketplace.
In an earlier cycle, a highly charismatic industry leader told us that internet traffic was doubling every 2 weeks. The credit markets had a massive boom of issuance to finance the build out of the fiber optic cable that was necessary during this period. And so we had multi-billion dollar issues from telecom companies, WorldCom, Global Crossing, a bunch of other companies. And it was a massive, very similar kind of period to what we're going through right now. And everybody believed Bernie Ebbers.
I would answer it this way. The entire investment philosophy that I talked about before, which was alpha at the core and beta around the alpha, is to mitigate those incorrect decisions. And so the alpha generators that we hire, which are managers like this that are 24/7 looking at what they're doing every single day, we hire them to be the active managers. And the reason we hire them is not because we want them to get every trade right. We want them, when they're wrong, they have good risk management and do they preserve capital. The beta around it, which is what everybody else has here, and we all have it in our portfolios, is we're long the market, we're long the S&P, the NASDAQ, all the Meg 7. That's going to just ebb and flow with the markets. And for years, we might look like geniuses, but every once in a while, we're going to look like idiots, right? The core piece that we're talking about, we're going to hold them to a much higher standard. Now, if they start deviating from risk management and all of a sudden their losers become much larger than their winners, then they violate their own risk management. And to me, I want my managers 24/7 watching it. I don't want us trading tactically every single day, moving it around. We don't have the bandwidth. These guys have hundreds of people in some cases, thousands in some cases, right? That's who I want, right? And I'll pay extra for that because if they can deliver risk management in a 2022 or 2020 or 2008, it's worth every cent. All right, well, that is the end of the fireside chat. Thank you, everybody, for doing this. Really appreciate it.